Joining us from Princeton University is economist Paul Krugman. His latest book, The Return of Depression Economics and the Crisis of 2008. Thanks very much for being with us on C-SPAN.
Good morning.
Let me begin by asking you something that you point out throughout the book, and that is the Asia crisis, saying that it was a dress rehearsal for what we're dealing with today. How so?
Well, there were two basic stories in the Asian crisis. One was about a wealthy, politically stable country that sort of seemed to have its act together, Japan, which found itself unable to cope, found itself in a kind of low-key version of depression conditions and unable to get itself out for a whole decade. And that's us right now. The other was about countries that had been stars, that had been attracting lots of foreign capital, that had been growing like gangbusters, that suddenly had a crisis of confidence and everybody flowing, all the money flowing out, and suddenly these economies turning into train wrecks. That was Indonesia, South Korea at that point, and now that's a lot of Eastern Europe. So we're actually seeing something that looks very much like what the world went through 10 years ago, except this time it's bigger. It includes all of the world's economies, and we should have seen it coming, and here it is.
And whether it is Asia or also in Latin America, in which you asked the question, why did so many ignore what was happening in Latin America, again as a precursor to what we're dealing with today in Europe, in the U.S., in North America, and elsewhere?
Yeah, there's a tendency, I guess we all have it, but certainly in the United States, we tend to think that we're different. The rules don't apply to us. That we look at something, we look at the crisis in Japan in the 90s, which from my point of view, was an omen, was very ominous for us. But people said, well, you know, they're different. They're Japan. They eat raw fish. They have banks that are, you know, unlike our banks, their banks are making a lot of bum loans. And we look at things that happen in places like Argentina or Brazil, and we say, well, that just shows how feckless those Latins are. And it wasn't until it finally arrived on our own doorstep that we faced up to the reality that, you know, we can get into trouble too, and in very much the same ways that these other countries did, and of course in very much the same way that we got in trouble in the 1930s.
In your book you keep saying we need to have informed action. Specifically, what are you talking about?
Well, first of all, you need to understand the lessons of the Great Depression, the lessons of these slumps. You need to drop some of the, you know, we went through a whole period when we were dominated by people who thought that tax cuts and deregulation were the answer to all problems. And right now we're in a situation where the frontline defense against this crisis is taking a much firmer hand and possibly nationalizing some banks, and on the other side, a large expansion of government spending to prop up demand. So you really need to, you can't do this by sloganeering, and unfortunately that's the way we've been doing economic policy for quite a long time.
So what is a bank today?
Well, that's really important. Part of the way we got into this mess was that we had excessive literalism. We said that a bank is a big marble building with a row of tellers, right? And the trouble is, and big marble buildings with rows of tellers have FDIC guarantees, they're at least somewhat regulated, so we thought, well, our banking system is safe. But it turns out anybody who borrows money, relatively short term, and then invests it in risky, longer term and illiquid assets, things that are hard to sell, is a bank. Whether they're called a bank or not, whether they're regulated or not. Hedge funds are banks, investment banks are banks, money market funds are banks, and this whole thing, the shadow banking system, all the things we don't call banks, but were in effect banks, that was bigger than the conventional banking system a year and a half ago, and it has largely imploded now.
In the book, you quote Ben Bernanke and Robert Lucas, two leading economists who, a couple of years ago in 2005, basically were saying that things were turning around.
Well, they basically said that we had this thing under control. Now, there was a period for about 20 years we didn't have really severe recessions, and we didn't have serious inflation, and people started to buy into it. It was called the Great Moderation. The idea, well, you know, we got this thing covered. We know how to do this. Uncle Alan Greenspan can take care of anything that comes along. Tremendous sense of complacency. Now, I have to say, Bernanke is a mixed figure here, because although he did buy into that, he also was very worried about the Japanese example. So in some ways, Bernanke came into his current job better prepared than almost anyone else to deal with it. But yeah, there was an enormous sense that, hey, we got this problem solved. Let's worry about other things. And Robert Lucas, great economist, but he did say, hey, he said, the problem of depression prevention has been solved. And it turns out not so much.
Our guest is Paul Krugman, who's joining us from the Princeton University campus. Our phone lines are open. You can also email us, journal@cspan.org, the winner of the 2008 Nobel Prize in Economics, and we're delighted that you're with us in the program this morning. This morning, the Washington Times has a front-page headline that says, the Japanese economy is in a free fall. Your reaction?
Yeah, we're all waiting for the official number, which should be announced Monday their time, so late Sunday hours, and it's probably, their economy is probably shrinking at a 10% rate or more. They got out of their lost decade of the 90s largely with an export boom. And a lot of that being directly or indirectly exports to us. So they were exporting components to China, which were then assembled into stuff. And so with the world world trade is in free fall and is dragging Japan down with it. And this is not, we shouldn't take any comfort in the fact that some other countries are doing worse than we are, because we're all linked together. This collapse in Japan, the bad news from China, the bad news from Europe, all redounds back to growing financial and economic troubles here. We're all feeding off each other's misery, you might say.
And yet you point out that from 1953 to 1973, Japan had the most remarkable expansion of the economy out of any country, greater even than the Soviet Union. So can they take lessons from that period and apply that today?
Well, a lot of what went right in Japan in the post-war generation was catch-up. This was a highly educated, sophisticated economy that was not caught up technologically with the United States, and so they could do a lot of fast growth by just sort of moving up to the technological frontier from a position way back. So that's not a good lesson, but they did seem to have a pretty well-managed economy until the late 80s, when they had a huge housing and stock bubble, and when the bubble burst, they fell into a kind of persistent, almost permanent slump. Any resemblance to the United States right now is unfortunately all too relevant. It does seem that the Japanese lesson was that you can have a sophisticated government, more or less stable political system, people who are not stupid, not crazy, running your country, and you can be a rich country, and even so, everything can go wrong. And again, we're witnessing that here.
Our guest, Paul Krugman, who's the Woodrow Wilson School of Economics professor, joining us from the Princeton University campus. Among his other books, The Conscience of a Liberal, The Great Unraveling, Fuzzy Math, The Accidental Theorist, and Peddling Prosperity. When you were announced as the 2008 winner of the Nobel Prize in Economics, your reaction?
Well, when I got the call, the first reaction was, that's obviously a fake Swedish accent, and which of my colleagues is playing a practical joke on me. It's funny. It's this kind of deadening reaction. It's like, oh my God, I don't quite believe this, and I didn't go whooping with joy. I just sort of was shocked. It's taken a while to get happy about it.
Roswell, Georgia, Democrats Line with Dr. Paul Krugman. Go ahead, please.
Hi, Dr. Krugman. I enjoy your blog and your column. Thank you so much for both. I had a question specifically about I first noticed it on CNN with Representative Marcy Castro, I believe, of Ohio, talking about the Produce to Note strategy for helping people to stay in their homes that had been foreclosed upon, and started looking into it a little more. Thought it sounded more fringy because my mother is in a closure situation. The attorneys that I'm talking to here now are saying that there's really something to this. The banks have not been able to produce any notes as far as they've seen, and that this really might start cascading into quite a problem. And I wanted to know how you think that would affect the solvency of the banks.
You're talking about the inability to produce documentation that they actually sort of own the mortgage? I'm sorry, I didn't quite get what the question was.
Yes, that they actually, there's a very good chance that they do not have the legal standing to be bringing foreclosures on, because these notes seem to have either been destroyed or lost in the vast majority.
Yeah, it's an unholy mess, and I mean, while we may be happy that some people aren't foreclosed on because the bank can't actually produce documentation that the loan is good. From a larger point of view, this is scary because we have, it's going to even add to the losses. The financial system is going to be even shakier. It's just a mark of how crazy the housing bubble was, that there were banks so frantic to make loans and then to sell them and slice and dice them and all, that no legally valid records were kept of who actually owed what to whom, and it's a mess. I think in the end it's only going to add somewhat to what's already a pretty terrible situation. The major banks are, if not literally insolvent, close enough that they need massive government aid to function. So this is just going to add to that.
Anderson, South Carolina. Good morning. Republican line.
Yes, sir. I know that World War II got us out of the Great Depression a little bit to a certain extent. I was just wondering if we do go back into a situation to where if we are in a depression or everybody just doesn't have a job and doesn't work, if the thing that Congress passed, is it really going to help or is it going to hurt the American people?
Okay, yeah, it's going to help. What we have is a situation where corporations are cutting back on investment, consumers are cutting back, they're saving, they're not spending, home construction is flat on its back, so there just isn't enough spending to keep people employed in this economy. The government, by doing a fair bit of spending, and also the federal government by helping the states avoid cutbacks, that's all going to help. Now, it's not going to be enough. It's not going to be enough anyway to keep this from being a very serious, very serious slump, which it already is, but it's going to get worse even with this program. So it's in the right order. It's in the right direction, but it's not the right size. I mean, you want to think about it. This program is going to be about 2.5% of gross domestic product for the next 2 years. World War II was about 40% of GDP for 4 years. So, if you think of World War II as your model, this is not even a decimal point in that.
Do you worry about deficits?
Yeah, I worry about them. Now, there's a question though, how much should you worry and what are your priorities? So the United States, yeah, we're going to be increasing our deficit. We're going to be running up a lot of debt in this thing, and but you want to have some sense of perspective here. The United States, at the end of World War II, we had a government debt that was 110% of GDP. We came into this crisis with a debt of 45% of GDP. A number of other wealthy countries have had debts that were 85, 90% of GDP. So we probably are capable of running deficits that push the debt up by as much as 40% of GDP, which is $6 trillion, without becoming a crisis country, without people saying, oh, I don't want to lend to them because they have too much debt. You don't want to do that casually, and that's not unlimited playing room because these things can be very, very expensive. This kind of crisis can be expensive. But we do have room to run. It's not that next year's deficit is going to make the United States into a banana republic. It would take 5-6 years of deficits like that to turn us into a banana republic.
Our guest is author and Professor Paul Krugman. He is at the Woodrow Wilson School of Economics, joining us from the campus of Princeton University. He also writes a column for the New York Times, Fortune magazine, and Slate. He also has a regular blog, which is available where, Professor Krugman?
Krugman.blogs.nytimes.com. It's the New York Times site.
And our next call is from Urbana, Illinois. Good morning.
Hi, thanks for taking my call. Mr. Krugman represents the Keynesian view of the economy, and he was blindsided by this debacle. The Austrians, on the other hand, represented by Ron Paul and the Mises Institute and Peter Schiff, did predict this. And now they're the ones that are given the role of getting us out of this debacle, but they didn't predict it.
Boy, I don't even want to go into the Austrian stuff. It's not major school. But look, what can you say? I was closer to this than the bulk of the people who were giving pronouncements about the economy. I saw the housing bubble. I saw that the bursting of the housing bubble was going to be nasty. So I don't know what more to say. We can, we can bring in Austrians, we can bring in whatever you want, but this is a classic crisis. Let me just say that. This looks very much like what happened in the beginning of the 30s. It looks very much like what happened in Japan. And those of us who did see those parallels, I think, are in better shape to at least hopefully find a way out than people who assured us that everything was fine, which was what happened with a good part of certainly the previous administration's favorite economists.
So the lessons, whether it's the tulip mania in Holland or the internet mania here in the U.S., what can we take away from these bubbles?
Well, I mean, bubbles happen. Bubbles in which people begin to believe that prices of assets only go up happen. Defective financial systems happen. Banking crises, very much. And we thought we had ended those, but it turns out that the banking system was not effectively regulated. But this is bigger. The main thing I think to understand is that this is much bigger than the dot-com bubble of the late 90s. This is on the same scale as the great Japanese bubble of the 80s, and therefore it's very, very serious.
Our next call from Homestead, Florida, Republican line. Good morning. Welcome to the program. Homestead, you with us?
Is that me?
It sure is. Good morning.
All right, good morning. I'd like to ask Mr. Krugman, and he just said that the crisis of the late 80s, Ronald Reagan, he was insulted, called all kind of names, when he shrugged his shoulders and did nothing. He let the courts go by, the bankruptcy courts, 800 banks went under. Everybody called Mr. Reagan an idiot, stupid actor. The crisis is not even remembered anymore. And it was solved in months. The market recovery, that was the worst mark, including this normal.
We'll get a response.
I actually have no idea what the caller is talking about. I'm sorry, I don't know what that was about.
We were talking earlier to callers about presidents, and one of the issues that came up was the package that President Reagan put in place back in the early 1980s that resulted in tax cuts, and whether or not that spurred the economic growth of the 1980s.
Well, that's a whole different story, but tax cuts do put money in people's pockets. They spend some of it. It is expansionary sum. I would argue that monetary policy had a much bigger role. We had an extremely severe recession in the early 80s because the Federal Reserve raised interest rates to squeeze inflation out of the system. When the Fed decided that we had suffered enough, it cut interest rates and the economy came bouncing right back. And by the end of the Reagan years, the economy was more or less back on its long-term trend. There wasn't any exceptional growth. There was a very severe slump and then a recovery. Maybe the caller is talking about the savings and loan crisis, where that was actually a very bad thing. Savings and loans were in trouble in the early 80s. The Reagan administration thought that the way to deal with that was to deregulate so they could grow their way out of the problem. Instead, they dug themselves in much deeper, and they ended up being bailed out at a cost of $130 billion in taxpayer money, back when $130 billion was a lot of money. The equivalent right now would be something like a $600 billion bailout, and this crisis is much bigger than the S&L. So actually the story of the savings and loan crisis suggests both that this is going to be very expensive and that we're going to have government takeover of a lot of banks.
For our audience listening on C-SPAN Radio, our guest is Paul Krugman, winner of the 2008 Nobel Prize in Economics. This email, Professor Krugman, from a viewer in Augusta, Georgia. Do you believe it's time for one standard method of accounting practices for government and businesses? No one still seems to know the true value of, quote, the toxic assets from bank to bank. That's what I believe is scaring private investors away from purchasing and managing these so-called bad mortgages.
Well, we do have a consistent standard for businesses. We don't apply the same rules to government, although I think you could argue that there are reasons why you don't want to do that. The government is not, the government has the ability to raise taxes, which a business does not. But anyway, and the problem with valuing the toxic assets is partly that there's no market in them. There's not a standardized toxic asset. They're all different kinds. When banks do try to sell them, they get very low prices. So they're mostly not selling them. I don't actually think that the uncertainty is the issue. I think actually we're fairly certain that a lot of big banks are more or less underwater. That's the reason we're not managing to get the investment going, and we need to do something to resolve that.
On the Democrats line, Glenville, New York, good morning.
Good morning. Hi, Professor. Thanks for taking my call.
Hi.
I'm 52 years old, and I kind of noticed over the years that when we get into these slumps, when the slump when we start to come out of it, interest rates go sky high, and then inflation seems to go into hyperdrive. And like my own credit card, I had a 0% interest rate, then it went to 7.9. And just yesterday, I get a notice that it's up to 18%. And I've only carried a balance for the past 3 months on that, which I didn't do anything to provoke that increase. It just happened. So my question to you is, one, how can I protect myself in the future from inflation and these crazy interest rates?
Okay, well, inflation is, by the way, not a problem right now. I don't think it's going to be a problem. I'm much more worried about deflation. If you look, overall consumer prices are falling, not rising right now, and it's just, now the interest rates, I mean, what's happening there under credit card is a combination. I think it's partly that there is some outrageous behavior by the credit card issuing companies, but also there's been a huge increase in losses on credit cards. Basically, more and more people are finding themselves unable to pay the balances, and so the issuers take a loss. And so the interest rates on those cards have gone way up. Plus, when you run up a balance on your credit card, the bank that issues the credit card usually sells off the claims on you to somebody else, the securitization. Nobody's buying that stuff right now. So this is all, it's what you're actually seeing is the flip side of the financial crisis is hitting credit card interest rates. What you do to protect yourself is be financially prudent, save, don't rely on those credit card balances. Easier said than done, I know, but basically, we went through a long period when people didn't do very much saving, believing that rising home values, a booming economy would take care of them, and that has turned out not to be true, and a little return to the old-fashioned virtues of thrift and prudence is what we need now.
Bradford, Pennsylvania, Republican line, good morning.
Good morning, Mr. Krugman. I'm concerned about the Republican Party. I actually think they disappeared for 8 years. Suddenly they have a philosophy that they completely undermined. I think the lobbyists took them over. I think we got into this war for lobbyists. And this war was probably the worst thing that happened to Israel and the worst thing that happened to the United States.
And everybody knows my political views, and I'm not too fond of the way the Republican Party ran the country these past 8 years. But I think it's wrong to say that there was a huge break. This was pretty much the same Republican Party that we've had for 30 years. The policies of the Bush administration, when you come down to it, were not that different from the policies of the Reagan administration. Tax cuts, a lot of talk about cutting spending, but actually not much actual cutting in spending. The whole deregulation, really not very different. And so this is what you've had. I think a fair number of people I know who are Republicans still have an image of the Republican Party as it was. The Republican Party of the 1960s, 1970s, which was a very different animal from what we have right now, and you go with the party you have, not the party you might want.
This program is carried live on the BBC Parliament channel in Great Britain. Our next call is from London. Go ahead, please. Welcome to the program.
Hello, Professor Krugman. I'd like to know your views on nationalization of the banks. If you think that they should be nationalized, or if there are any merits to keeping them private right now.
I'm for nationalizing any bank that requires lots and lots of aid, which is probably at least 4 or 5 of the top 10 banks in the United States, maybe more. Maybe we shouldn't call it nationalization, because nobody wants. I certainly don't want the government in the permanent position of running the banks, but it's receivership. If the government is going to pump in enough money to make these banks viable again, there's really no way to do that except by taking temporary ownership of the banks. And yeah, if we go in, I was just doing the numbers. You look at the top 4 money center banks in the United States. They have a combined stock value of about $200 billion. They clearly need at least $450 billion of government aid. There's no way to pour in that much aid for banks that are worth so little, and actually even part of what they're worth is probably hoping for a windfall from the government, that without effectively taking ownership. So just go ahead and do it. As everyone's saying, we're all Swedes now. We need to do what Sweden did with its troubled banks. We need to do what we did with our own savings and loans at the end of the 80s. Get in there, have the government take temporary control, clean up the balance sheet, resell them after that.
In fact, Matthew Richardson and Nouriel Roubini have a piece this morning in the Washington Post saying, quote, how Swede it is to shore up the banks, nationalize them, and they put this in terms of numbers, saying that the total losses on loans made by U.S. banks and the fall of the market value of the assets could reach $3.6 trillion, and that the U.S. banking sector is exposed to half of that figure, almost $2 trillion.
Right. Their numbers may, I'm hoping their numbers are on the high side, but even the IMF, the International Monetary Fund, is giving you numbers of $2.2 trillion now. So we're all looking at this and saying these are essentially a large part of our banking system is insolvent. And we need to keep that system in existence because it's the lubrication for the economy, but there's no way to pour in enough money to keep it working without either providing a huge unjustified windfall to executives and stockholders or taking control.
On the independent line, we'll listen to this next caller from Delray Beach, Florida, for Professor Paul Krugman. Good morning.
Yeah, good morning, Dr. Krugman. I have 2 questions for you. The first one is, what's so bad with the proposed notion that if people were to receive money from the government in taxes or et cetera, if they would be putting that money back into their savings? Essentially, their savings, meaning that bank will go to the banks.
Yeah, the trouble with that, nothing wrong with people having more savings. The trouble is that money will not be doing anything to create jobs. If I take money and put it in the bank, then the bank will, in fact, sit on it, because that's what's happening right now. Banks are very reluctant to lend, and actually businesses are reluctant to borrow as well. So if the government does rebates, tax cuts, and people just sock the money away, it does nothing to help other people get jobs. And what we're deeply concerned about right now is the jobs picture. We're looking at an unemployment rate that is very likely to go to 9%, quite easily go to more than 10%. That is scary stuff. That's an enormous amount of human hardship. Helping people have more money in the bank with money that the federal government borrows is not solving that problem.
And you go back in the book, one of the lessons may not even be from the Great Depression of 1932, but the bank fallout of 1907 and the ultimate bailout by bankers like J.P. Morgan. Can you elaborate?
Yeah, well, the 1907 crisis has a lot of, it's very antique right now, but it actually bears a lot of resemblance to the current one. There too, there was a somewhat regulated banking system, but the parts of it that were not regulated went out of control. And there was no Federal Reserve at that point. The federal government didn't get involved in these things. So J.P. Morgan, the person, not the bank, was able to arrange a kind of private bailout of the system, arrange to have him and his friends getting together to put up enough money to avert the worst of the crisis. It's a cautionary tale, both because it shows how a banking system can fall apart through incomplete regulation, and because you can't always count on having a J.P. Morgan around. And that's why we need this government role. In fact, the response to that crisis was the creation of the Federal Reserve, because people looked and said, gee, J.P. Morgan saved us this year, but what happens when this happens the next time? And we're having a sort of souped-up version of that now. We're having a revelation that our system is out of control, that we need a better mechanism for dealing with these things, and above all, we need a huge effort to rescue ourselves right now.
The book is called The Return of Depression Economics and the Crisis of 2008. Our guest is Paul Krugman. Our next call is Glen Allen, Virginia. Good morning.
Good morning. Professor Krugman, I have a concept for a very unique type of new economy. I wonder if you've ever given thought to the power of cyberspace related to creating new economies. I wrote a brief article called America's New Transformational Economy based upon cows standing for corporate opportunity websites. And there's all kinds of spin-offs that I have available. There's all kinds of job opportunities that can be creative. There's ways to empower individuals and small businesses so that they can expand and diversify their interests to an unlimited degree in any field of interest. I've tested these concepts back in the 80s, and they are magnified 1,000 times more in today's technology world. And just one other thing related to economies, are you familiar with the Venus Project at all in Venus, Florida? This gentleman has laid out our whole future, and he's talking about a worldwide non-monetary economy. Your thoughts on cyberspace and creating new economies, and if you have any interest, I'll be happy to contact you.
Okay, look, I'm all for trying out new concepts. I'd be surprised about a non-monetary economy because I think we haven't transcended the use of money. The money gets more abstract. We're no longer doing very much business with gold coins and a lot of business with pretty abstract credit instruments. But we do need money still to make transactions. Look, I would just say that given the urgency of the crisis, while we want to try to be creative, we don't want to be jumping too far into the future because we got to do stuff now. I mean, there's a reason why most of the stuff in the stimulus bill that just passed is repairing roads and bridges, repairing schools, rather than fundamentally blue sky new projects, because we need stuff that's going to deal with a crisis that is not only imminent, but we're well into it. We're sliding down this slope, and we need a break right now.
The web, if you want to check out more of Paul Krugman's work, is krugman.blogs.nytimes.com, Winter Haven, Florida. Good morning, Democrats Line.
I've been reading John Kenneth Galbraith's The Great Crash of 1929, and by page 62 already I see some similarities with what we're going through right now. But I wanted to ask you about our future economy. If we, as citizens on a microeconomic level, can start, trying to rally our communities to start insulating our houses better, which will put a lot of people to work and which will cause the manufacture of insulation and something along that nature, where I think we tend to sit back and go, oh my God, they've got to fix it from above.
Well, okay, I guess my basic reaction is, oh my God, they've got to fix it from above. The trouble, we're in Alice through the Looking Glass territory here. We're in a world which is something that's familiar, by the way, if you know about the 30s or Japan in the 90s. We're in a world where actually individuals doing good things, reasonable things, actually collectively make things worse. So everybody has decided that actually, I ought to save. I shouldn't be relying on something or other to take care of me. I should be saving more, which is a good thing. But when everybody does it, it depresses the economy and leaves us all worse off. We have a situation where financial institutions, the ones that are not yet underwater, are saying, gee, we really need to be more prudent. We need to reduce our leverage. We need to sell off some of our assets and pay off some of our debt. But when everybody does it, that causes a credit crunch and a collapse in the markets. So this is not something, I mean, by all means, people should do what they can, and in some cases, communities may be able to get together to do better things, but this is really, by its nature, it's the kind of problem that requires a top-down solution. I don't like that in general, but this really is. This is something where doing the right thing by each of us actually produces the wrong result for the economy, and so it's up to Washington and Brussels and Tokyo to solve this problem.
So when you hear, as you write in the book, that these problems are structural economic issues with no quick cure, what's your reaction?
I get angry at that. I mean, yes, there are, we have structural problems with our economy. We have things that are fundamentally wrong, but so does everybody, always. There are always structural problems. What we have right now, this minute, is a collapse in demand, collapse in spending. And what we need to do is get the spending back up so as to avoid mass unemployment. Yes, we need to fix our banking system. Yes, we need to become a more prudent nation. We need to become more energy efficient, all of these things. But while we're on the way to doing that, we don't need to experience a second Great Depression.
Houston, Texas, good morning.
Hi, how are you all? Thanks for taking my call.
Well, glad to hear from you. Thank you for phoning in.
If I have all my money in the bank, which I do I run a risk of it losing value for all that's going on?
No. I mean, if it's FDIC insured, no. I mean, it's backed by the full faith and credit of the U.S. government, and while the U.S. government is not utterly secure, if the U.S. government goes, so does everything else. So it's as safe as anything can be. So no, banks, the regular, what I said earlier in this program, big marble buildings with lines of tellers, those are as secure as anything can be in this universe. So no, don't worry about that.
This viewer from New Hampshire saying that the Republican Party has focused on home loans to minorities as being the catalyst to the economic crisis, the current crisis. But didn't George W. Bush state that minority home ownership was one of the pillars of his economic program? And in doing so, the viewer wants to know if that was not a good thing.
First of all, the whole story is untrue. If you actually look at where the losses are occurring, they're across all income groups, they're across all races. It's not the case that the mortgage defaults, that the problems are concentrated in low-income minority homeowners. It just isn't true. Just flatly untrue. And furthermore, there wasn't really an effective policy from Washington pushing for those kinds of loans either. There were some. The Community Reinvestment Act goes back to 1977. It's nothing new, and it only applied to certain kinds of banks, and those were not the banks that made most of the loans that took place leading up to this crisis. So the whole thing is false. Now, yes, President Bush did talk about home ownership and how we want more people to have homes. Wasn't very successful at that. Home ownership now is below its levels when he took office. So the whole thing, it's a complete attempt to shift the blame onto the victims.
Final question. What is your economic outlook? How long do you think the current situation will last as it now stands? When do you think we will see a turnaround?
Those are different questions. I think we'll see a turnaround, at least in GDP, late this year, early next year. We'll see some uptick in some economic indicators. My guess is unemployment will keep rising, quite possibly up through the end of next year, to levels that are going to be range between awful and horrifying. And this is going to go on for a long, long time. Everything about it points to a sustained slump that's going to go on for 3, 4, maybe even 5 years, maybe even more than that. Maybe it's a Japanese-style lost decade. This is the worst. This is not a self-curing slump, put it that way. This is a slump that is going to dig itself in. It's going to burrow into the ground and stay there unless we have much more effective policies even than we've seen proposed so far.
And finally, where do you see a silver lining? Where do you see hope in the economy?
I think maybe this has finally killed the view that markets are self-regulating and bankers know what they're doing, and there's no need for a social safety net. So the silver lining is not economic so much as it is political. I think we may be rediscovering some of the lessons our grandfathers learned during the New Deal, and hopefully we can construct a modern version of the New Deal to deal with the economy we have now.
Paul Krugman is a professor of economics at the Woodrow Wilson School at Princeton University. He's joining us from the New Jersey campus. His latest book, The Return of Depression Economics and the Crisis of 2008. Thank you for your time. Please come back to C-SPAN.
Thank you.